Welcome to Killik & Co.'s podcast for today, 29th of July, in what is going to be another busy week, both on the corporate front and also for macro data. The big story today on the corporate news front is the merger, $35 billion merger between Omnicom and Publicis, which is going to create the largest company in the sort of advertising space, overtaking WPP Group. However, we believe that WPP Group actually may be a beneficiary of this merger between Omnicom and Publicis, and that the client conflicts created by that merger could actually see WPP winning some business in this space. The shares in WPP have ticked up a little bit today, as we can see from this chart. We're up sort of around the £12 level. WPP is also one of the companies which we feature on our big data note, which was released by the research team recently. So please do take a look at that note. On the indices generally, the S&P 500 was back towards its record levels last week as markets generally consolidated after what had been quite a good run. There has been one noticeable development today though. We've seen the Nikkei, Japan's Nikkei 225 index fall off quite sharply. It's over 3% down today. Some concerns that a raising of sales tax, potential raising of sales tax there may have some negative impact on the economic recovery that we've seen there so far. And also we've seen the yen strengthen. The yen's strengthened quite a bit today. And that's obviously with the Nikkei 225 index having a lot of exporters as constituents of the index. A strengthening of the currency is generally going to be viewed as a negative for the index, as the exporters don't benefit as much from a strengthening currency. Overall, though, the policies which have been adopted by Shinzo Abe and generally to get the economy going again and getting a bit of a boost to inflation has been paying off in terms of what's been happening on the economic forecasts. This chart here shows the increase in economic forecasts, or the consensus for the economic forecasts over the year so far, from the beginning of this year, and this is for 2013. So you can see that economists generally have become more positive on the economy in Japan and have been raising their forecasts as a result of the policies that are being adopted there. One thing that we're going to see this week, or in fact three of the major central banks are going to be making their rate decisions this week. Perhaps that's the Bank of England, the ECB and the Federal Reserve Bank, but perhaps the biggest focus is going to be on the Federal Reserve, particularly given all the talk of tapering that we've seen. Since Ben Bernanke started introducing the concept of perhaps curtailing some of the stimulus that we've seen into the economy in the US, we have seen that the yield curve in the US steepen quite significantly. Although the short end of the curve remains quite well anchored, and we'll come on to that in a little while as to explain why that is, we have seen longer dated rates rise quite significantly, as you can see from this chart. The first curve here is where the rates were at the time of his speech when he mentioned tapering, and the top curve just indicates where we are today ahead of the policy meeting coming up. If we look at the 10-year benchmark, this actually shows in probably a little bit more detail as what we have seen. We've seen this is in the US and also the UK, because the UK tends to follow the US to some degree. Most of these markets will follow the US curve in the developed markets, the core markets. So the US curve, the US 10-year Treasury yield did rise quite significantly after that initial tapering talk, but it has retreated a little bit. We were back below the 2.6 now, and the UK as well, having hit almost that 2.6 level, is back down now below the 2.4 level. So we have seen some recovery in the core Treasury and gilt markets. recently. But obviously this is going to be a key focus going forward as more and more talk emerges and the likelihood of tapering of stimulus it becomes more likely. Just obviously, one of the things which Ben Bernanke has been quite keen to stress is that any withdrawal or curtailment of stimulus in the US economy is going to be data dependent. And on that front, we have had some quite good economic news recently. So on balance, we'd probably say that we are looking to get some tapering this year, potentially as early as September. And we had some more data last week actually, which was fairly positive. This is the consumer confidence, the University of Michigan Consumer Confidence Indicator, which showed that consumer confidence actually was the highest level it's been since the start of the financial crisis. So a positive data point there. The biggest data point this week is likely to be the non-farm payrolls data. This is due out on Friday. We're expecting to see about 185,000 jobs added over the past month on the non-farms. This compares to about 195,000 last month. Generally, with participation rates of around about 63.5%, if we keep adding jobs at around this level, or around maybe slightly more, around the 200,000 level, we should see the unemployment rate come down to the 6.5% rate, which the Fed is looking for. That should happen around about November time 2014. So we're some way off that at this stage. We expect to see the unemployment rate drop from 7.6% to about 7.5%. However, that does not preclude the Fed from starting its tapering. That 6.5% is really a level which the Fed has mentioned as the potential level at which interest rates in the US may start to rise. In fact, what the Fed has said is that it may stay, the interest rates may stay low at least until it's 6.5% on the unemployment rate. So we may get further guidance actually on that at some point in the future. Where that level is actually decreased to about 6% before we actually see interest rates going up. So I think there's an opportunity again for the Fed to try and distinguish tapering or the curtailment of stimulus from the actual raising of interest rates when he next speaks, when Bernanke next speaks. But of course, it's worth mentioning there's one other thing which is going to come into this whole process of normalization of policy, and of course that is inflation. At the moment, there's a lot of attention being paid onto the non-farm payrolls and the unemployment data, but we need to remember that while inflation is low, there is still room for maneuver on the stimulus front, and with inflation at these current levels, I think the Fed would probably be quite concerned about withdrawing stimulus too soon.